Before we begin, it's critical to understand that I am not a licensed financial advisor, and this video is for educational and entertainment purposes only. The information presented here is based on extensive research and experience, but it does not constitute financial, legal, or tax advice. Your personal financial situation is unique, so please consult with a qualified professional before making any significant financial decisions. Let's talk about two brothers, Mark and David. In 2019, they both decided it was time to buy their first home. They had similar jobs, similar savings, similar credit scores. They were on an identical journey. Mark, the older brother, was a numbers guy. He lived in spreadsheets. He spent weeks comparing every lender he could find, hunting for the absolute lowest interest rate. And he found it. A mortgage at 2.49%. He called David ecstatic. "I won," he said. "I beat the system. The rate you got is 3.1. I'm going to save thousands." David congratulated him, but felt a small sting of defeat. Had he made a mistake? Was he a sucker for taking a higher rate? For the first 2 years, Mark was living the dream. His mortgage payment was significantly lower than David's. He had more cash every month. He bought new furniture, took a vacation. He would gently rib David at family dinners, calling his own loan the genius mortgage. David just smiled and said he was happy with his predictable payment. Then year 3 hit, and Mark's world turned upside down. An email from his lender landed in his inbox. The subject line: upcoming adjustment to your monthly payment. His genius 2.49% rate was gone. It had been a promotional rate, part of a 3-to-1 adjustable rate mortgage, or ARM. His new rate, tied to the soaring market rates, had just jumped to over 6%. His monthly payment didn't just go up, it nearly doubled overnight. Panic set in. He thought, "No problem, I'll just refinance." But when he looked at the fine print of his original loan, the fine print he'd ignored in his obsessive hunt for the lowest number, he found a gut punch. A massive prepayment penalty. It would cost him over $10,000 just to get out of the loan. He was trapped. Meanwhile, David was paying the exact same amount he had on day one. His 3.1% rate was a 30-year fixed. It would never change. While Mark was now house poor, stressing about every single dollar and watching interest rates like a hawk, David was calmly building equity, his financial future secure. Mark didn't get the best deal. He got the best advertisement. He fell for the lowest rate illusion, a trap that costs Americans billions of dollars every single year. This illusion is one of the most powerful and deceptive forces in personal finance. And in this presentation, we are going to systematically dismantle it. We are going to expose the hidden fees, the confusing terms, and the psychological tricks that banks, lenders, and dealerships use to make a terrible deal look like the deal of a lifetime. My promise to you is this: by the time you finish this video, you will have a rock-solid framework for analyzing any loan. A mortgage, a car loan, a student loan, even a credit card offer. You will be able to look past the shiny advertised number and see the real cost, the true deal. You will learn how to spot the red flags that Mark missed. You will understand the critical difference between an interest rate and an APR. You'll know why a prepayment penalty can be a financial prison. And I will give you the exact questions to ask any loan officer that will immediately tell you whether they are being transparent or trying to pull a fast one. This knowledge isn't just about saving a few bucks. It's about protecting yourself from catastrophic financial mistakes. It's about ensuring your peace of mind for years, even decades to come. So why are we so obsessed with that one little number? The interest rate. It's because our brains are wired for simplicity. We use mental shortcuts called heuristics to make complex decisions easier. When we see a wall of loan options, our brain instinctively searches for the simplest metric to compare them. And what's simpler than the lowest number? 2.49 is lower than 3.1. End of story. Decision made. Lenders know this. They spend billions on marketing that exploits this very human tendency. They dangle that low rate in front of you like a hypnotist's watch. It's the headline. It's in bold print. It's all they want you to focus on. Think of it like booking a flight on a budget airline. You see a flight to Miami for $49. It's an incredible price. You click on it, but then the process begins. You want to choose your seat? That's $25. You have a carry-on bag? That's $50. You need to check a bag? That's another $60. You want a water on the plane? $5. By the time you're done, your $49 flight actually costs $189. Meanwhile, another airline had a flight for $140, and it included a seat, a carry-on, a checked bag, and a free drink. The better deal was the one with the higher initial price. Loans are the exact same thing. The interest rate is the $49 ticket price. It's just the bait. The real cost of the loan is hidden in all the other fees and terms, the financial equivalent of bag fees and seat selection. These are things like origination fees, which is what the lender charges you just for creating the loan. They can be thousands of dollars. There are discount points where you pay more money up front to buy a lower rate. There are underwriting fees, processing fees, appraisal fees, title insurance fees. The list goes on and on. All of these costs are baked into your loan, but they are not reflected in that shiny, simple interest rate. So if the interest rate is the marketing gimmick, what's the real number we should be looking at? It's called the APR, or the annual percentage rate. The APR is your secret weapon. The APR is required by federal law in the United States to include most of those extra fees and costs rolled into one single percentage. It gives you a much more honest apples-to-apples comparison of what you're actually paying. A loan with a 3% interest rate but high fees might have an APR of 3.5%. Another loan with a 3.1% interest rate but very low fees might have an APR of 3.25%. In that case, the loan with the higher interest rate is actually the cheaper loan. Mark never looked at the APR. He was so fixated on the interest rate that he completely ignored the more important number sitting right next to it on the loan estimate. He saw 2.49%, and his brain shut off. He didn't see the thousands in origination fees. He didn't see the clauses about the adjustable rate. He didn't see the prepayment penalty that would later become the bars of his financial cage. He only saw the bait, and he took it. This is the first and most fundamental rule in escaping the lowest rate illusion. Always, always, always compare loans using the APR, not the advertised interest rate. The interest rate tells a story. The APR tells the truth. But even the APR doesn't tell the whole truth. Because as we saw with Mark, the type of loan you get can be just as, if not more, important than the rate itself. And that brings us to the great debate, fixed versus adjustable. The battle between predictability and risk. It's the classic financial showdown, a heavyweight title fight for your mortgage. In one corner, you have the reigning champion of stability, the 30-year fixed-rate mortgage. It's dependable. It's predictable. It's the Tom Hanks of home loans. You know exactly what you're going to get, and it's probably going to be pretty solid. In the other corner, you have the challenger, the agile and sometimes unpredictable adjustable-rate mortgage, or ARM. This is the wild card, the high-risk, high-reward player that promises a lower price of admission, but with a catch. To understand this battle, let's meet Sarah and David. They're friends, both looking to buy their first homes in the same city, around the same time. They have similar jobs, similar credit scores, and similar down payments. On paper, they are nearly identical buyers, but their mindset is worlds apart. Sarah is a planner. She budgets her groceries, maps out her retirement contributions, and she likes to know with absolute certainty what her expenses will be next month, next year, and 10 years from now. David is more of an optimist, a bit of a risk taker. He believes in his ability to earn more in the future, and is comfortable with a little uncertainty if it means saving money right now. They both go to the same lender. Sarah is offered a 30-year fixed-rate mortgage at 6.5%. Her monthly principal and interest payment on a $400,000 loan would be about $2,528. It's a big number, but it's a known number. For the next 360 months, as long as she lives in that house, that number will not change. Then it's David's turn. The lender presents him with a different option. A 5-to-1 ARM with a starting interest rate of just 4.5%. His monthly payment, only $2,026. David's eyes light up. That's over $500 a month less than Sarah's payment. That's a car payment. That's a vacation fund. That's a serious chunk of change. He calls Sarah immediately. Can you believe it? I got a rate that's 2 full points lower than yours. You should see if you can get the same deal. You're leaving money on the table. And for a moment, Sarah feels a pang of doubt. Is she being a fool? Is her desire for safety costing her over $6,000 a year? This is the siren song of the adjustable rate mortgage. That low initial teaser rate is designed to be incredibly attractive. It pulls you in by showing you an immediate, tangible financial benefit. But what David isn't fully grasping, and what the lender briefly glossed over, is the structure behind that number. What does 5-1 ARM actually mean? Let's break it down because this is where the devil hides in the details. The 5 represents the initial fixed-rate period. For the first 5 years, David's loan acts just like a fixed-rate mortgage. His 4.5% rate is locked in. He can enjoy that lower payment feeling smart and savvy. But after 60 months, the second number, the 1, kicks in. This means his interest rate will adjust once every 1 year for the remaining 25 years of the loan. And here's the critical question. What does it adjust to? It's not arbitrary. The new rate is calculated using a simple formula. Index plus margin. The margin is the easy part. It's the lender's profit, a fixed percentage that never changes. Let's say David's margin is 2.75%. The index is the variable, the part that gives the loan its risk. This is a benchmark interest rate that reflects broad economic conditions, like the SOFR rate. When you hear on the news that the Federal Reserve is raising rates to fight inflation, that directly influences the index your ARM is tied to. So, 5 years from now, David's new rate will be whatever the index is at that time, plus his 2.75% margin. If the index is at 4%, his new rate becomes 6.75%, higher than Sarah's fixed rate. If the index has shot up to 6%, his new rate becomes a whopping 8.75%. Now you might be thinking, that's terrifying. It could go to the moon. And it could, but there are safety measures built in called caps. These are the most important and most often misunderstood features of an ARM. There are 3 of them. First is the initial adjustment cap. This limits how much the rate can jump the very first time it adjusts. Common cap is 2%. So if David's rate is 4.5% after 5 years, the highest it can go is 6.5%, even if the index plus margin formula says it should be higher. Second is the subsequent adjustment cap. This limits how much the rate can change in all the following years. This is also often 2%. So, in year 7, his rate could go from 6.5% to a maximum of 8.5%. Finally, and most importantly, there's the lifetime cap. This is the absolute ceiling your rate can ever hit. It's usually 5% or 6% above your initial start rate. For David, a 5% lifetime cap means his 4.5% ARM can never ever go higher than 9.5%. So let's play this out. For 5 years, David saves $502 a month compared to Sarah. That's a total savings of just over $30,000. He feels like a genius. But then year 6 arrives. The economic climate has shifted. Rates are up. His loan adjusts for the first time and hits its initial cap, jumping from 4.5% to 6.5%. Suddenly, his monthly payment is no longer $2,026. It's now $2,583. In a single month, his payment has increased by $557. He's now paying more than Sarah, and his $30,000 in savings is starting to erode. In year 7, rates are still high. His loan adjusts again, this time to 7.5%. Now his payment is $2,844 a month. He's paying over $300 more than Sarah, and the erosion of his initial savings is accelerating. He's stressed. He's checking interest rate forecasts. His financial peace of mind is gone. Meanwhile, Sarah is just paying her $2,528. She doesn't think about it. It's automatic. She's sleeping soundly at night. Now, does this mean ARMs are always a bad idea? Absolutely not. For the right person in the right situation, they can be a brilliant financial tool. Who is that person? It could be someone who knows with near 100% certainty that they will be selling the house before the initial fixed period is over. Maybe it's a medical resident who knows they're moving for a fellowship in 4 years. Or a military family with orders for a 3-year station. They get all the benefit of the low teaser rate and get out before the risk of adjustment ever kicks in. It could also be a high-income earner who can easily absorb the worst-case scenario payment. If David's payment jumped to $3,500, and he had the cash flow to handle it without breaking a sweat, the initial savings might be worth the gamble. He's essentially using his financial stability to bet that rates won't rise dramatically. The riskiest strategy of all is taking an ARM because you believe rates will go down. If rates fall, David's payment would adjust downwards, and he would have truly won the bet. But timing the interest rate market is like timing the stock market. Even the world's most brilliant economists get it wrong all the time. It's a huge gamble to take with the roof over your head. The problem is, most people who take ARMs are like David. They aren't 100% sure they'll move. They can't necessarily absorb a 50% payment increase with ease. They're just seduced by that initial low number. focusing on the best-case scenario while underestimating the very real possibility of the worst. They choose the ARM not as a calculated strategy, but as a way to afford a more expensive house than they otherwise could. And that is a recipe for disaster. It's what led to the 2008 financial crisis, when millions of homeowners with adjustable-rate loans faced foreclosure when their payments ballooned. So David is betting on the future, and Sarah is paying for certainty. Seems like a simple choice between risk and stability, but what if I told you there's a third, hidden player in this game? A factor that can make a good rate on paper a financial nightmare in reality. We're talking about the silent killer of home loans, the fees. And they come in a form you'd never expect. They're called discount points. And the most dangerous thing about them is that they're not a hidden fee. They're not some line item buried in the fine print. They are a fee you are offered, a fee you are encouraged to pay, a fee that you willingly hand over in exchange for that shiny low interest rate. It's the ultimate financial sleight of hand. The lender shows you this beautiful low number with one hand, while the other hand is reaching into your pocket for thousands of dollars up front. So what exactly is a discount point? Think of it like this: you're at the grocery store and you can buy a coupon book for $20. That coupon book will save you $2 on your groceries every week. Sounds like a good deal. But the real question is, how many weeks will it take for your savings to pay for the cost of the coupon book? That's a discount point in a nutshell. You are paying a lump sum of cash at closing to buy down your interest rate for the life of the loan. 1 point costs 1% of your total loan amount. So, on a $400,000 loan, 1 point is a $4,000 fee. 2 points is an $8,000 fee. This is cash you have to bring to the closing table on top of your down payment, on top of all your other closing costs. You are literally prepaying interest to get a lower monthly payment. Now let's go back to our couple, Mark and Sarah. This is where the story gets interesting. Remember, Mark secured that amazing 6.25% rate from a lender we'll call Rate Slasher Loans. He was ecstatic. He called Sarah and bragged about how he'd beaten her 6.5% rate. But here's what he didn't mention, what he maybe didn't even fully understand himself. To get that 6.25% rate, Rate Slasher Loans charged him 2 discount points. Sarah, on the other hand, got her 6.5% rate from Steady Home Mortgage with 0 points. Let's do the math and see who really won. On their $400,000 loans, Mark's 2 points cost him $8,000 cash out of his pocket on day one. Sarah paid $0 for her rate. She kept that $8,000 in her bank account. Now let's look at the monthly payments. Mark's payment at 6.25% is about $2,462. Sarah's payment at 6.5% is about $2,528. So, Mark is saving $66 every single month. Over 30 years, that adds up, right? This is the moment where Mark feels like a genius. He's saving $66 a month. Feels like a clear victory. But wait, he paid $8,000 to get that $66 a month savings. This is the part almost everyone misses. We have to figure out his break-even point. How long does Mark have to live in that house making that payment just to earn back the $8,000 he paid up front? We take the cost, $8,000, and we divide it by the monthly savings, $66. The answer is 121 months. That's 10 years and 1 month. Mark does not see a single penny of actual savings until he has lived in that house for over a decade. For the first 10 years, he is simply paying himself back for the fee he paid on day one. And this exposes the giant, flashing, red alert risk that the low-rate lenders never talk about. The entire bet hinges on one thing. Mark has to stay in that house with that exact same loan for more than 10 years. What happens if he gets a fantastic job offer in another state 5 years from now? He sells the house. He paid $8,000 for a benefit he only used for half the payback period. He effectively lit $4,000 on fire. What if, in 7 years, he and his wife have 2 more kids and need to buy a bigger house? Same story. He sells, he loses thousands. What if interest rates plummet in 3 years and he wants to refinance to a new, lower rate? The moment he refinances, that old loan is gone, and so is the $8,000 he paid for it. He loses again. The average American homeowner moves roughly once every 9 to 10 years. The bet that Mark made, the bet that he would stay in that house for over a decade, is statistically a coin flip at best. He traded a huge pile of cash, real tangible money he could have used for furniture, for repairs, for an emergency fund, or to invest, for a tiny monthly savings that is completely dependent on his life staying exactly the same for the next 10 years. Now look at Sarah. She paid 0 points. She kept her $8,000. That cash is her safety net. It's her flexibility. It's her freedom. Yes, her monthly payment is $66 higher. But if she gets that same job offer in 5 years, she sells the house and walks away clean. She hasn't lost a dime. If she wants to refinance in 3 years, no problem. There's no unrecouped cost she has to worry about. She holds all the power. Who has more peace of mind? The person who is tied to their home for a decade, or the person who is free to make the best decision for their family at any time? The lowest rate isn't always the best option. Sometimes it's a trap. It's a marketing gimmick designed to appeal to our brain's obsession with getting the best deal, while obscuring the true cost. Lenders know that a headline screaming 6.25% is way more powerful than one that says, "Pay us $8,000 today to save $66 a month." And here's the real mind bender. It's not just a choice between points and no points. It's a whole spectrum. The interest rate you are quoted is not a fixed number sent down from the heavens. It is a product. You can buy a different one. The lender could have offered Mark a 6% rate for 4 points. That's a $16,000 fee. Or they could have offered Sarah a 6.75% rate, but with negative points, meaning the lender would have actually given her a credit of thousands of dollars to help pay her other closing costs. It's a sliding scale of cash today versus cash over time. And your decision has to be based on your personal timeline, not on a lender's advertisement. The question you have to ask yourself isn't, what's the lowest rate? It's how long am I realistically going to have this loan? If you are 100% certain you're in your forever home and will never move or refinance, then maybe, just maybe, paying points makes sense. For almost everyone else, it's a gamble where the odds are stacked against you. So Mark didn't find a better rate than Sarah. He bought a different financial product. He chose a high upfront cost for a small long-term discount. Sarah chose a zero upfront cost for maximum flexibility. Neither is universally right or wrong, but one is far, far riskier. The story of discount points is the single biggest secret in the mortgage industry. It's how lenders can advertise impossibly low rates and lure you in. But it's only the beginning, because these optional points are just one type of fee you'll encounter. What about all the others? The processing fees, the underwriting fees, the admin fees, the courier fees. The list goes on and on. Some are legitimate, but many are what we in the industry call junk fees, pure profit centers for the lender, disguised as necessary costs. And telling the difference between the two is the next critical skill you need to avoid being ripped off. How do you spot them? And more importantly, how do you fight them? Starts with a document, a 3-page form from the lender called the loan estimate. This isn't just a piece of paper. It's the battlefield. It's where the war over your money is won or lost, long before you ever get the keys to your house. Most people glance at the big numbers, the loan amount, the interest rate, and then their eyes glaze over as they scan the long list of itemized costs in Section B and C. And that's exactly what the lender is counting on. They're hiding a minefield of bogus charges in plain sight, using confusing names and industry jargon to make you think they're all standard. They are not. Think of these closing costs in 3 categories. First, there are the legitimate, non-negotiable third-party fees. These are costs for services performed by someone other than the lender, and they're unavoidable. Things like the appraisal fee, which pays a licensed appraiser to determine the home's value. The credit report fee, which pays one of the big 3 bureaus to pull your history. Title insurance, which protects you and the lender from claims against the property's ownership. These are real services with real costs, and while you can shop around for some of them like title services, you can't just wish them away. They're the cost of doing business. But then we enter the second category, the gray area. These are the lender's own fees. And this is where the art of the hustle truly begins. These fees have official sounding names like underwriting fee, processing fee, or administration fee. On the surface, they seem reasonable. I mean, someone has to process the paperwork and a professional underwriter has to approve the loan, right? Yes, but here's the billion-dollar secret. That's their job. That's what they're already getting paid to do through the interest rate you're paying them for the next 30 years. Charging you a separate underwriting fee is like going to a fancy steakhouse, ordering a 20-ounce ribeye for $70, and then seeing a separate $30 cooking fee on your bill. You'd call the manager. You'd say, "Isn't the cooking part of the service included in the price of the steak?" And you'd be right. The lender's profit, their salary, their office lights, it's all supposed to be baked into the interest rate. These extra fees are them trying to double dip. A processing fee of $500? For what? For a loan officer to collect your pay stubs and bank statements and upload them to a software program? It's a task that takes a few hours at most. An administration fee? It's so vague it's insulting. It's a fee for administering things. It's a fee for having a fee. These are the fees you must question relentlessly. They are often pure profit, padded to the gills and highly negotiable. Because they aren't for a tangible third-party service, the lender can change them, reduce them, or if you push hard enough, eliminate them entirely. They exist simply because people pay them without asking questions. And that brings us to the third category, the most infuriating of all. These aren't gray areas. These are the junk fees in their purest, most shameless form. This is the financial equivalent of finding a cockroach in your salad. I'm talking about things like a document preparation fee. You're charging me to print a standard government-mandated form from a computer? Are you running low on toner? What about a funding fee? Not to be confused with a government VA or FHA funding fee. This is the lender's own fee. They are charging you a fee for the act of giving you the loan. It is the single most ridiculous concept in finance. It's like an ATM charging you a cash dispensing fee on top of the regular service fee. It's the definition of their entire business. You might see an application fee. You already applied. They got your business because of it. Why are you paying for the privilege of giving them your business? Or how about a courier fee of $75 in an age of email and DocuSign? Are they sending your W-2s across town via a man on a horse? It's nonsense. These are the fees that are 100% unequivocally pure lender profit. They exist for no other reason than to extract more money from your pocket at closing. They are a test to see if you are paying attention. So how do you fight back? How do you go from being a victim to being a warrior? It's a 4-step process. Step 1 is the most important. You never ever look at just one loan estimate. You must get at least 3 from 3 different lenders: a bank, a credit union, and a mortgage broker. This is your ammunition. Without comparison, you have zero leverage. You're just complaining. With 3 loan estimates side by side, you're negotiating from a position of power. Step 2. You ignore the interest rate for a moment. You heard me. Forget the big number at the top. You print out the loan estimates and you go directly to page 2, to the loan cost section. You put them next to each other and you get out a highlighter. You go line by line. Lender A is charging a $900 underwriting fee. Lender B is charging $400. Lender C isn't charging one at all, but calls it a processing fee. You highlight every single one of these lender-specific fees. Step 3 is where you pick up the phone. You call Lender A, the one with the lowest interest rate that got you all excited. And you say this calmly and politely: "Hi, I'm looking at your loan estimate, and I see you have a $900 underwriting fee and a $300 processing fee. I have another offer here from Lender B, and they don't have these fees. Can you explain to me what these are for? And can you waive them to match the other offer?" Now watch what happens. The loan officer will stammer. They'll give you a pre-rehearsed speech about how these are their standard costs. They'll say it's for the hard work their team does. This is where you don't back down. You hold the line. You say, "I understand, but the other lender seems to be able to do the same hard work without charging an extra $1,200. If you can't waive those fees, then your loan is actually more expensive, even with the lower interest rate." You are now speaking their language. You've exposed the shell game. You've shown them that you see the total cost, not just the shiny interest rate they dangled in front of you. Suddenly, those non-negotiable fees become very negotiable. You'll hear a lot of typing on their keyboard. A nervous cough. Then, "Okay, let me talk to my manager and see what I can do." That's the sound of you winning. That's the sound of you saving $1,000 in 10 minutes. And that leads to step 4. Be prepared to walk away. The single greatest power you have in any negotiation is the ability to say no thank you, and mean it. Lenders spend a fortune on marketing to get you in the door. The last thing they want is for you to leave after they've spent time and money on your application. They are counting on you feeling like it's too late to back out. It is never too late, not until you have signed the final papers. Remember, they need you more than you need them. There are thousands of lenders, but there is only one of you. By following this process, you can surgically remove thousands of dollars in pure junk from your closing costs. You've done it. You've navigated the minefield, you've called their bluff, and you've crafted a loan that's not just low on interest but low on cost. You feel confident. You feel in control. You've chosen your lender, locked in your rate, and you've got a loan estimate that looks clean. The hard part is over, right? Wrong. The game isn't over. The lender has one last, powerful card to play, and they often wait until the final 72 hours before you get your keys to reveal it. It comes in the form of a final document, one that looks deceptively similar to your estimate, called the closing disclosure. And sometimes the numbers on it, the ones you fought so hard for, don't match what you agreed to, and they're counting on the fact that you're too tired, too excited, and too close to the finish line to fight back. That single piece of paper, that closing disclosure, is where the magic trick happens. It's the final reveal. And if you don't know what you're looking for, you're the perfect audience for a disappearing act, where the thing disappearing is the money in your bank account. The lender is banking on a psychological principle: commitment and consistency. You've come this far. You've told your friends and family you're buying the house. You've packed boxes. You've emotionally moved in. To back out now, over a few $1,000s? Feels impossible. Feels like failure. So most people just sign. They absorb the unexpected cost, telling themselves it's just part of the process. But it's not. It's part of a strategy. Let's pull back the curtain. The first document you got, the loan estimate, was exactly that, an estimate. But federal law dictates how much certain fees are allowed to change between that initial estimate and the final closing disclosure. They're broken into 3 categories. First, there are the fees that cannot change at all. Zero tolerance. This includes the lender's origination charge and any fees you pay for locking in your interest rate, which are called points. If that number changes, it's a major red flag. Second, there's a category of fees that can't increase by more than 10% combined. These are things like the recording fees the county charges, and fees for services where the lender requires you to use a specific third-party company, like a particular appraiser or credit reporting agency. But then there's the third category, the Wild West. These are the services you can shop for yourself. Things like title insurance, pest inspections, and survey fees. The lender has to give you a list of providers, but you are not required to use them. And because you can shop for them, the lender has no legal limit on how much these estimated costs can change if you just go with their guy. And guess what? Most first-time buyers, overwhelmed by the process, just go with their guy. They don't shop around for title insurance. Who has time for that? And that's where the costs can quietly balloon. So let's walk through this minefield together. Imagine you're looking at your closing disclosure. Page 2 is where the action is. Look at Section A, Origination Charges. This is the lender's paycheck. It's the fee they charge for creating the loan. A low-rate lender might compensate by charging a massive, non-negotiable origination fee, sometimes labeled as an underwriting fee, processing fee, or application fee. They might quote you a rate that's 1/8 of a point lower than their competitor, saving you maybe $30 a month, but then they slam you with a $2,000 processing fee that the other lender wasn't charging. Over the first 5 years, you've barely broken even. Now jump down to Section C, services you can shop for. This is huge. The biggest line item here is almost always title insurance. Title insurance protects you and the lender from any future claims on the property from long-lost heirs or secret liens. It's essential, but the prices can vary by hundreds, even thousands of dollars. The lender's preferred title company might not be the cheapest. They might be preferred because they're easy for the lender to work with, or because of a cozy business relationship. You have the right, and you absolutely should, call 3 or 4 different title companies and get quotes. That 1 hour of work could save you $1,000 in cash you need for closing. Then you have the prepaids and the escrows. This is the part that confuses everyone, and it's a masterclass in financial sleight of hand. Sections F and G. These aren't fees. This is your money. It's you prepaying for things like homeowners insurance and property taxes. Your lender requires you to pay the first full year of your homeowner's insurance premium upfront. They also require you to set up an escrow account. Think of escrow as a savings account that the lender manages for you. Every month, part of your mortgage payment goes into this account, and the lender uses that money to pay your property taxes and insurance on your behalf when they're due. It ensures the bills get paid, protecting their investment, your house. At closing, you have to put some seed money into that escrow account, usually a few months' worth of taxes and insurance, to make sure there's always a cushion. Here's the trick. On the initial loan estimate, a sneaky lender might deliberately underestimate your annual property taxes. They'll lowball it, so your estimated cash to close looks fantastic, very affordable. But then, right before closing, they get the actual tax bill from the county. And surprise! It's double what they estimated. Now, you suddenly need to bring an extra $2,000 to the closing table to properly fund your escrow account. It's your money, yes, but it's cash you weren't expecting to part with, cash you might not have. And it's all because they weren't honest with their initial estimate. They sold you on a low cash-to-close figure they knew wasn't real. This is exactly what happened to a guy named Mark. Mark was a savvy shopper. He got quotes from 5 different lenders. 4 were clustered around 6.5%. But one online lender, let's call them Quickie Loans, offered him 6.25%. A quarter-point difference. It looked like a slam dunk. The loan estimate from Quickie Loans looked amazing. His closing costs were low. His cash to close was manageable. He was thrilled. He went through the whole process, got his appraisal done, got his final approval. Then, 3 days before closing, he got the closing disclosure. His stomach dropped. The 6.25% interest rate was there, just as promised. But the total cash he needed to bring to closing was nearly $6,000 more than the original estimate. He frantically scanned the document. What happened? First, in Section A, a mysterious $1,500 loan processing fee had appeared that wasn't on the estimate. When he called, they said it was standard. Second, the title services in Section C were $1,200 higher than the estimate. He had just used their recommended company without thinking. Third, and this was the knockout blow, they had estimated his property taxes at $3,000 for the year. The actual bill was $6,500. This meant his initial escrow deposit skyrocketed, demanding another $3,000 in cash right now. That best interest rate of 6.25% just cost him $6,000 he hadn't budgeted for. He had to drain his emergency fund just to close on the house. Meanwhile, the lender who quoted him 6.5% had much lower fees and a far more accurate estimate of his taxes. Had he gone with them, his monthly payment would have been about $50 higher, but his cash to close would have been $5,000 lower. Which one was really the better deal? The lowest rate that stripped him of his emergency savings, or the slightly higher rate that left him in a secure financial position after closing? This reveals the fundamental truth of mortgages. There is a seesaw, an eternal trade-off, between your interest rate and your closing costs. You can almost always get a lower rate if you're willing to pay more money up front. This is called paying points. 1 point is equal to 1% of the loan amount. So on a $400,000 loan, 1 point costs you $4,000 in cash at closing. In exchange, the lender might reduce your interest rate by, say, 0.25%. You are essentially prepaying interest to have a lower monthly payment for the life of the loan. The reverse is also true. If you're short on cash for closing, you can take a slightly higher interest rate, and the lender will give you a credit to cover some, or even all, of your closing costs. This is called a lender credit. The lender is essentially paying your closing costs for you, and they make their money back over time through the higher interest rate you're paying them every month. Neither of these options is inherently good or bad. They are tools. They are strategies. Paying points to buy down your rate might be a brilliant move if you know you're going to be in that house for 30 years. Taking a lender credit to get into the house with zero closing costs might be the only way a young family can afford to buy their first home. The problem isn't the options. The problem is that many lenders present only one option, the one that looks best on a comparison sheet, without explaining the trade-offs. They sell the lowest rate because it's the easiest thing to market. But the best loan isn't a number. It's a strategy tailored to your specific life. So how do you decide? How do you know if you should pay the points, take the standard rate, or ask for a credit? The answer depends on one crucial question you have to ask yourself. A question that has nothing to do with a calculator and everything to do with your future. How long are you actually going to be in this loan? Not the house, the loan. That's it. That's the multi-$1,000 question. It's the key that unlocks this entire puzzle of points, credits, and interest rates. Because when you pay points, you are prepaying interest. You're making a bet. You're betting that you'll stay in that loan long enough for the monthly savings to eventually add up and surpass the upfront fee you paid. And if you take a lender credit, you're making the opposite bet. You're betting you'll be out of that loan before the slightly higher monthly payment eats away at the cash you saved at closing. This is a game of time, and the fulcrum, the tipping point, is something the mortgage industry calls the break-even point. Understanding this one concept will make you smarter than 90% of homebuyers. The break-even point is the exact moment in time when the money you saved each month by buying down your rate finally equals the amount of money you paid up front for the points. Before you reach that point, you're technically in the red on your decision. After you cross that point, every single mortgage payment you make is pure, unadulterated savings. It's profit. Let's make this real. Imagine a couple, we'll call them Mark and Jessica. They're buying a $400,000 home. They found the neighborhood they love. The school district is perfect for their 2 young kids. And they see this as their forever home. They plan on being there for the next 20, maybe 30 years until the kids are grown and gone. Their lender presents them with 3 options. Option A is the standard or par rate of 7%. No points, no credits. Their principal and interest payment is $2,661 a month. Option B is the discounted rate. The lender says, if you pay us 1 point, which remember is 1% of the loan amount, so $4,000 in this case, we can lower your rate to 6.625%. Running the numbers, their new monthly payment would be $2,558. So Mark and Jessica are looking at this. They can pay $4,000 extra at closing to save $103 every single month. Is this a good deal? To figure this out, we calculate the break-even point. It's simple division. You take the total cost of the points, $4,000, and you divide it by the monthly savings, $103. 4,000 divided by 103 equals 38.8. Let's call it 39. This means it will take them 39 months to break even. For the first 3 years and 3 months, that $4,000 they spent is just slowly being paid back to them in the form of a lower monthly payment. But on month 40, they've officially broken even. Every $103 savings from that point forward is pure financial gain. Since Mark and Jessica plan on staying in the home for decades, this is a fantastic deal. Over a 30-year loan, they'll be past their break-even point for 261 months. Multiplying that by their $103 in monthly savings, they will end up saving over $26,800 in interest over the life of the loan, all because they paid $4,000 up front. For them, for their specific life plan, paying points was the smartest financial move they could make. But now let's look at a different home buyer. Let's call him David. David is a young software engineer who just got a great job in a new city. He's tired of renting and he wants to start building equity. He's buying a small condo for the same $400,000. But Dave knows his industry. He knows that in 3 to 5 years a better opportunity might come up in another city, or even with another company in the same town. He sees this condo as a great starter home, a stepping stone, not a final destination. David gets the same 3 options from his lender: the 7% par rate, the 6.625% rate for 1 point. But he's also offered option C, the lender credit. The lender says, look, we can give you a rate of 7.375%, which is a little higher. But in exchange, we will give you a credit of $3,000 to use toward your closing costs. David's monthly payment at this higher rate would be $2,761. That's $100 more per month than the standard rate, and $203 more than the discounted rate. On the surface, this sounds like a terrible deal. Why would anyone willingly pay more every single month? Because David isn't thinking about 30 years from now. He's thinking about next month. He's thinking about the $10,000 in closing costs he has to bring to the table. That $3,000 credit from the lender means he only has to come up with $7,000 out of pocket. That's a huge immediate benefit. It means he can keep more cash in his emergency fund, or buy furniture for his new place without going into credit card debt. For David, paying an extra $100 a month is a small price to pay for having $3,000 in his pocket right now. He's essentially financing a portion of his closing costs into the loan. And let's think about his timeline. He expects to be gone in, let's say, 4 years, which is 48 months. If he had paid the $4,000 for the points, he would have sold the house only 9 months after his break-even point. He would have spent $4,000 just to save about $927. A net loss of over $3,000. By taking the credit, he saved $3,000 at closing. Over the 4 years he lives there, he will pay an extra $4,800 because of the higher monthly payment. So his net cost is $1,800. But he gained immediate financial flexibility and avoided draining his savings. For his short-term plan, taking the credit and the higher rate that came with it was the absolute right call. So we have 2 different people, 2 identical loans, and 2 completely opposite best answers. The math is simple, but it's driven entirely by that one personal question. How long will you be in this loan? If your answer is forever, or at least a very long time, you should always run the numbers on paying points. If your answer is definitely not long, Say less than 5 years, you should always ask about lender credits to reduce your closing costs. And if your answer is a shrug, if you have absolutely no idea what the future holds, then the standard par rate is your safest bet. You're not paying extra and you're not getting a credit. You're just taking the market rate for that day. But there's a trap here. A massive variable that can turn this entire calculation on its head. We've been asking the question, how long do you plan to stay in the house? But I was very specific at the beginning. The real question is, how long will you be in this loan? Because you can stay in a house for 30 years but be in 3 or 4 different loans on that same property. This is called refinancing. And it changes everything. What happens if you're Mark and Jessica are a forever home couple, and you pay $4,000 to buy down your rate, fully expecting to be there for 30 years to reap those $26,000 in savings, but then 2 years later, interest rates across the entire country plummet. Suddenly, that 6.625% rate you paid for looks ridiculously expensive when new rates are at 5%. You'd refinance in a heartbeat. And in that moment, you've just willingly turned your 30-year plan into a 2-year plan. You're now David, the short-termer. You spent $4,000 to save money, but because you refinanced before your break-even point, you actually lost thousands. The decision that seemed so smart, so logical, so mathematically sound, just became a costly mistake. So how do you account for something you can't possibly predict? How do you factor in the wild, unpredictable future of the entire economy into this deeply personal financial decision? You're not just betting on your own life plan anymore. You're betting on the future of interest rates themselves. And that is a much, much scarier bet to make. So let's talk about that bet. Because while it is scary, it's not always a bad one. The problem isn't the bet itself. It's that most people don't even realize they're sitting at the table. Chips already pushed to the center. They just saw the low number, signed the paper, and hoped for the best. But for a select few, the adjustable rate mortgage isn't a gamble. It's a calculated, strategic tool. It's a financial scalpel, used with precision to achieve a very specific outcome. To understand this, we need to meet a couple of people. First, let's meet Anya. Anya is 28 years old and she is brilliant. She's in the 3rd year of her surgical residency at a major city hospital. For the last 7 years, she's lived on a diet of instant noodles, lukewarm coffee, and sheer determination. Her life is a blur of 80-hour work weeks and studying. Her income reflects this. As a resident, she makes about $60,000 a year. Enough to live, but barely enough to breathe in the city she works in. But Anya has something that most of us don't. A near certainty about her future income. In 2 years, she will finish her residency. She'll become an attending surgeon, and her income won't just increase, it will launch into the stratosphere. She'll jump from $60,000 to over $400,000 a year. It's not a hope, it's not a dream. It's the well-trodden, guaranteed path of her profession. Right now, Anya is tired of renting. She's tired of a long commute after a 24-hour shift. She found a small condo for sale just a few blocks from the hospital. It's perfect. But when she goes to the bank, she hits a wall. Based on her current $60,000 salary, the 30-year fixed-rate mortgage she can get is tiny. The monthly payment on the condo she wants at that fixed rate would consume almost her entire take-home pay. It's financially impossible. She's stuck. But then, a savvy loan officer presents her with another option, a 5-to-1 arm. The initial interest rate on this arm is a full 2 percentage points lower than the 30-year fixed. When she runs the numbers, the monthly payment is suddenly manageable. It's still tight, but it's doable. Now the old wisdom screams, don't do it. What happens in 5 years when that rate explodes? And that's a fair question for 99% of the population. But it's the wrong question for Anya. Anya isn't planning for 30 years. She's planning for the next 24 months. She knows that in 2 years, her income will multiply by 7. The bet she's making isn't that interest rates will stay low forever. Her bet is on herself. She's betting that she will finish her residency. That's it. In 5 years, when that rate is scheduled to adjust for the first time, she'll have been earning a surgeon's salary for 3 full years. She'll have a mountain of cash, 0 debt besides this mortgage, and a financial profile that banks drool over. At that point, what happens if rates have gone up? It almost doesn't matter. She can easily afford the higher payment. Or more likely, she'll simply walk into any bank she chooses and refinance that arm into a brand new fixed-rate mortgage at whatever the current rates are. The arm for her wasn't a permanent home. It was a bridge. It was a tool that allowed her to buy the home she needed, 2 years before the traditional financial world would have let her. She used the low initial rate to bridge the gap between her current reality and her predictable future. She didn't avoid the bet. She just stacked the deck so completely in her favor that it was impossible to lose. Now let's meet Mark and Sarah. They're a military family with 2 young kids. Mark is a captain in the Air Force, and they've just received orders to a new base in Texas. They know, with the same certainty as Anya's income, that they will be at this new base for 3, maybe 4 years, before they get new orders and have to move again. They're tired of throwing money away on rent. They want a backyard for their kids and a chance to build some equity. They find a perfect house in a good school district. Just like Anya, they look at the 30-year fixed rate. It's fine. But then they look at a 7-to-1 ARM. The rate is significantly lower. The monthly payment is $400 less. Over 4 years, that's a savings of over $19,000. Their friends, repeating the conventional wisdom, warn them about the rate adjustment. What happens in year 8 when it skyrockets? Mark and Sarah just smile, because they know they will be long gone by year 8. They'll be on their next adventure at a different base, probably on the other side of the country. Their bet has nothing to do with the future of the economy. Their bet is that the U.S. military will continue to operate the way it has for the last 50 years. They are certain they will sell this house in 3 to 4 years. Why would they pay a premium for 30 years of rate stability when they only need 4? For them, the 30-year fixed rate is like buying a lifetime warranty on a disposable camera. It's paying for a feature you know you will never ever use. The ARM perfectly aligns with their life's timeline. They get the benefit of the lower initial rate for the entire duration they own the home, and they sell it long before the risk part of the adjustable rate mortgage ever kicks in. The future rate adjustment isn't their problem. It vanishes the moment they sell the house. So you see, the question isn't whether ARMs are good or bad. That's amateur hour thinking. The real question is, what is your timeline? What is your exit strategy? The danger of an ARM is for the person who takes it with no plan, simply because the initial payment is cheaper. They are the person the bank is betting against. They are the person who, in 5 or 7 years, will be trapped. Their income hasn't dramatically increased, they have no plans to move, and suddenly they are at the mercy of global economic forces they have no control over. But if you are an Anya with a predictable and massive income jump on the horizon, or if you are a Mark and Sarah with a definitive and short-term plan to sell, then the ARM transforms. It stops being a gamble on interest rates and becomes a calculated strategy based on the known variables of your own life. You are no longer playing the bank's game, you are playing your own. This reveals the fundamental truth. The lowest number on the page only matters in the context of your own story. And this principle doesn't just apply to choosing between a fixed and an adjustable rate. It goes much, much deeper. It forces us to ask an even more counterintuitive question. If the lowest rate isn't always the best, could it be possible that sometimes, deliberately choosing a higher interest rate is actually the smartest financial decision you can make? Sounds like financial heresy. Sounds completely insane. But in the hidden world of mortgage finance, there are scenarios where paying a higher rate up front can unlock benefits that save you tens, or even hundreds of thousands of dollars down the road. It's about understanding the total cost of borrowing, not just the sticker price. And that is where we go next. Let's peel back the curtain on 3 specific scenarios. 3 stories of homebuyers who were faced with a choice, and the one who chose the higher interest rate came out on top. Our first story is about cash flow and time. Meet Alex and Ben. They're friends buying identical townhouses in the same neighborhood for the exact same price, $400,000. Both are disciplined savers and have their down payments ready. They go mortgage shopping. Alex is what we call a rate chaser. His entire focus is singular. Find the absolute lowest number possible. And he finds it. Fantastic rate, let's say 6%. He's ecstatic. But to get that rock bottom rate, the lender charges him $10,000 in closing costs, origination fees, processing fees, points to buy down the rate. Alex sees it as the cost of getting the best deal. He writes the check, drains a chunk of his savings, but locks in that beautiful low rate. His monthly principal and interest payment is about $2,400. Now let's look at Ben. Ben is more focused on his cash position. He thinks about opportunity cost. He asks his lender a different question. What can you do for me with 0 closing costs? The lender comes back with an offer. They'll give him a credit to cover that entire $10,000 in fees, but his interest rate will be higher. Let's call it 6.5%. His monthly payment is now about $2,530. That's $130 more than Alex's payment every single month. On the surface, Alex won, right? He has the lower payment. He's saving $130 a month. But here's where the story gets interesting. Ben kept $10,000 of cold, hard cash in his pocket. Alex's cash is gone forever, sunk into the transaction. For Alex's decision to be the right one, he needs to stay in that house long enough for his monthly savings to add up to the $10,000 he paid up front. So let's do the math. $10,000 divided by his monthly savings of $130. The answer is 77 months. That's almost 6.5 years. Alex has to live in that house without moving or refinancing for 6.5 years just to break even with Ben. But what do the national statistics tell us? The average homeowner in America moves or refinances every 5 to 7 years. Life happens. A job relocation, a growing family, a market shift. Let's say 5 years down the road, both Alex and Ben get job offers in another state and decide to sell. Alex has been diligently making his lower payments. Over those 60 months, he has saved $7,800 compared to Ben. But remember, he paid $10,000 to get that privilege. He is still $2,200 in the hole. He lost money. Ben, on the other hand, not only avoided that loss, but he had his $10,000 the whole time. What if he invested it? Even in a conservative index fund averaging an 8% return, that $10,000 would have grown to nearly $15,000 in those 5 years. So Ben is not only not in the hole, he's actually thousands of dollars ahead. By taking the higher interest rate, he won. He understood that the total cost wasn't just the monthly payment, it was the upfront cost plus the opportunity cost of that cash. Now for our second story. This one is about risk and peace of mind. Meet Chloe. Chloe is a first-time homebuyer. She's scraped together just enough for a down payment and is ready to buy her first condo. She finds the perfect place. But she is what the industry calls cash-to-close sensitive. After her down payment, she has very little left for closing costs, moving expenses, or that inevitable first-year emergency, like a water heater giving up the ghost. She gets a quote from a lender for the lowest possible rate, 6.25%. It's a great rate. The problem? It comes with $12,000 in closing costs. To pay that, she would have to drain every last penny from her savings account. She would be moving into her new home with a $0 emergency fund. That is a terrifyingly risky position to be in. One unexpected car repair, one medical bill, and she could be facing financial disaster, possibly even foreclosure, in her first year of homeownership. The stress is overwhelming. She's about to give up when a different loan officer shows her another option. He says, "Chloe, I can get you a rate of 7%. I know it's higher, but in exchange for that rate, the lender will give you a credit for the entire $12,000 in closing costs." Her monthly payment would be about $150 more. But she would walk away from the closing table with her entire emergency fund, let's say $15,000, still safely in her bank account. Which is the better deal? The world screaming lowest rate is best would point to the 6.25%. But for Chloe's specific situation, it's a trap. It's a path paved with crippling anxiety and risk. The 7% loan is her lifeline. It's a strategic tool. She can comfortably afford the extra $150 a month, but she absolutely cannot afford a sudden $5,000 expense. She takes the higher rate. She moves into her home with confidence. She sleeps at night knowing she has a financial cushion. Her plan? She's just dating the rate. She's not married to it. In a year or two, as she pays down her principal and hopefully the market rates have improved, she can refinance into a lower rate. The total extra interest she paid over those 2 years is a small price for the security and peace of mind that allowed her to buy her home safely. The higher rate wasn't a penalty. It was a premium she paid for financial insurance. Our final story is perhaps the most powerful, because it involves a fee that so many people pay without realizing there's a way out. It's about beating the system. Let's meet David and Emily. They're buying a $500,000 home and have saved up $75,000 for a down payment. That's 15% down. A fantastic achievement. They go to a bank, and the bank offers them a loan for the remaining $425,000. They get a great rate, let's say 6.1%. But because they have less than 20% down, the bank tells them they have to pay private mortgage insurance or PMI. PMI doesn't protect them. It protects the lender in case they default. It's pure cost. For their loan, the PMI is $250 a month. So their total payment is their mortgage principal and interest, plus this $250 fee that builds zero equity and offers them zero benefit. They're about to sign the papers when they talk to a mortgage broker who understands creative financing. The broker says, "Wait, I can get you a slightly higher rate on your main loan. Let's say 6.4%, but we can structure it to completely eliminate your PMI from day one. Here's how it works. It's called a piggyback loan. Instead of one giant loan, they take out two. The first mortgage is for exactly 80% of the home's value, $400,000. Because it's at that magic 80% threshold, it requires no PMI. The rate is a little higher, 6.4%, as the broker mentioned. Their 15% down payment covers $75,000. That leaves the remaining 5%, or $25,000. For that, they take out a second, smaller loan, often a home equity line of credit or HELOC. The rate on this second loan is much higher, maybe 9%. So now let's compare the two options. Option A, one big loan at a low rate of 6.1%, plus $250 in PMI. The total monthly housing payment comes out to about $2,827. Option B, two loans. The big one at a higher rate of 6.4%, and the small one at 9%. No PMI. The payment on the first mortgage is $2,500. The interest-only payment on the smaller second mortgage is about $188. The grand total? $2,688. Let that sink in. By taking a higher interest rate on their primary mortgage, their total monthly payment is $139 lower. Every single month, that's over $1,600 a year in savings. And here's the kicker. Mortgage interest on both the first and second loan is typically tax-deductible. PMI is not. So their real, after-tax savings are even greater. They used a higher rate as a strategic weapon to kill a useless fee and lower their overall cost. 3 stories, 3 different goals: cash flow, risk management, and fee avoidance. In every single case, the lowest interest rate was the wrong answer. It was a siren song, luring them toward a worse financial outcome. The best loan wasn't the one with the shiniest number. It was the one that was structured to solve their specific problem. So we've uncovered the hidden strategies the pros use. But knowing they exist and actually getting them are two different things. How do you walk into a lender's office and command these options instead of just being handed a rate sheet? That's the billion-dollar question. And the answer is coming up next. The answer isn't a secret handshake or a magic word. It's a strategy. It's about fundamentally changing the power dynamic between you and the lender. Most people walk into a bank, hat in hand, and ask, "Please, sir, may I have a loan?" They act like a supplicant asking for a favor. But you need to walk in like the CEO of a highly profitable, low-risk company. And that company is you. You aren't asking for their money as a gift. You are offering them a business opportunity. The chance to purchase a 30-year stream of reliable, predictable income from an exceptionally qualified client. You are the prize. They are competing for your business. When you internalize this shift in mindset, everything changes. So how do you project that? You do it by preparing what I call the underwriter's dream packet. An underwriter is the person in the back office, the real decision maker, who never meets you but decides your financial fate based on a pile of papers. Their job is to assess risk. Every question they have, every piece of missing information, every confusing entry on your bank statement is a point of friction. It's a risk flag. The more friction you create, the more they see you as a risk. The more risk they see, the worse your terms will be. Your goal is to make their job so breathtakingly easy, to present a file so clean, so organized, and so compelling, that approving you for the best possible terms is the most logical, effortless decision they will make all week. This goes way beyond just handing over your W-2s and bank statements. You're going to curate your financial story. First, your income. Don't just provide pay stubs. Create a simple cover sheet titled Income Verification Summary. List your employer, your position, your time on the job, and your base salary. If you have bonuses or commission, document the 2-year history clearly on that same page, showing the trend. If you recently got a big raise, include the official letter from your HR department. You're not making them hunt for the narrative. You're handing it to them on a silver platter. The story is, my income is stable, reliable, and growing. Next, your assets. This is where you really start to separate yourself from the average applicant. Lenders are required to verify you have funds for the down payment and closing costs. But you're going to show them more. You're going to include a statement of assets that lists not just the primary account for your down payment, but all your liquid assets. Checking, savings, brokerage accounts, retirement funds. You're not just proving you can afford the down payment. You're proving you have reserves. You're showing them you have a safety net. The gold standard is to show you have at least 6 months of pity. That's your full monthly housing payment. Principal, interest, taxes, and insurance. In reserve after you pay your down payment and closing costs. When an underwriter sees that, a light goes on in their head. This person isn't living on the edge. This person can weather a storm. This person is a prime, low-risk investment. Then comes your credit. Don't just rely on your FICO score. Pull your full credit reports from all 3 bureaus yourself weeks before you ever talk to a lender. Read every single line item. Did you have a late payment on a credit card 3 years ago because you were on vacation and forgot? Is there a medical collection for a bill you never even knew you had? Don't wait for the underwriter to find these and ask you about them. You get in front of it. You write what's called a letter of explanation or LOX. It should be brief, professional, and accountable. Regarding the 30-day late payment to Capital One in May of 2021, I was traveling internationally and mistakenly missed the payment due date. As you can see from my subsequent 36-month history of perfect on-time payments, this was an isolated incident and is not indicative of my creditworthiness. You attach this letter to your packet. You've taken a potential red flag and turned it into a demonstration of responsibility and transparency. Finally, you assemble it all. You create a professional-looking PDF, a cover page with your name and the property address, a table of contents. Every document is clearly labeled. The income summary, the asset statement, the letters of explanation, your tax returns, your W-2s, your bank statements, your photo ID. It's all in one file in a logical order. You have just saved your future loan officer and their underwriter hours of work. You have answered every question before they even thought to ask it. You have presented yourself not as an applicant, but as a business partner. Now you're ready to interview lenders. Notice the language. You are interviewing them, not the other way around. You will contact at least 3 to 5 different lenders on the same day. A big national bank, a local credit union, and a mortgage broker. When you speak to the loan officer, you don't start with, "What's your best rate?" That's an amateur move. Your first question is, "Can you tell me about the types of borrowers you typically work with and the loan products you specialize in?" You want to know if they're a good fit for you. Then you make your move. You say, "I'm a very well-qualified borrower, and I've prepared a comprehensive loan packet to make the underwriting process as smooth as possible. Would it be all right if I sent it over? I'm looking to get an official loan estimate." You send them your underwriter's dream packet. The reaction you get will be telling. A lazy loan officer might be confused, but a great one, their eyes will light up. They know you're serious. They know you're organized. And they know you're going to be an easy file to close, which is how they get paid. You've instantly become their favorite client of the day. Because you've made their job so easy, they are now more inclined to work hard for you. They'll fight to get you a better rate from the pricing desk. They'll see if they can waive certain lender fees. You've earned their respect. Once you have a few official loan estimates back, the real negotiation begins. You can now go back to the lender you liked best, the one who gave you the best service, and be completely transparent. "I really appreciate your help, and I'd love to work with you. However, I have another official loan estimate from Lender X that has slightly lower closing costs. Is there any flexibility on your lender fees to help close that gap?" This isn't being aggressive. It's being a savvy consumer. You're not just comparing the interest rate on line A. You're comparing the origination fees in box A, the appraisal fees, the credit report fees. You're comparing the total cost of the loan. Imagine 2 borrowers, both with a 780 credit score and 20% down. The first one, average Adam, just sends in his documents piecemeal and asks for the best rate. He gets the standard rate sheet offer, maybe 6.5% with $2,000 in lender fees. The second one, prepared Patricia, sends in her dream packet. The lender sees she has 12 months of reserves. They see her proactive letter of explanation. They know she's a sure thing. They offer her 6.375% and are willing to waive half their lender fees when she shows them a competitive offer. Over the life of the loan, that small difference, achieved not by luck, but by strategy and preparation, will save Patricia tens of thousands of dollars. This process transforms you from a price taker into a price maker. You're not at the mercy of the market. You're navigating it like a professional. You are commanding the best options because you've proven beyond a shadow of a doubt that you are the best possible investment a bank can make. But even after you've secured that perfect loan, there's one final critical piece of the puzzle that almost everyone overlooks. It's a decision you make at the closing table itself, a choice that can dramatically alter the future of your mortgage and your financial freedom. And it has nothing to do with the rate or the fees you just negotiated. It's a single line item buried deep within a mountain of paperwork, a box you check without a second thought. It's the decision of whether or not to allow your lender to sell your mortgage. And the truth is, for most conventional loans, you don't even have a choice. The fine print gives them the right to transfer the servicing of your loan to another company at any time. And they almost always do. You see, the friendly local lender who approved your loan, the one you built a rapport with, often isn't in the business of managing loans for 30 years. They're in the business of originating them. They are a factory. Once your loan is created, packaged, and closed, it's loaded onto a conveyor belt and shipped out to the secondary market, sold to a massive, faceless servicing company you've never heard of. You are no longer a client. You are an asset, an entry on a spreadsheet sold to the highest bidder. Let me tell you about a couple, Mark and Sarah. They did everything right. They followed all the advice we've talked about. They improved their credit, saved a massive down payment, and shopped around with 5 different lenders. They found a lender offering a rate that was 1/8 of a point lower than anyone else. It would save them about $40 a month. They were ecstatic. They felt like they had won the home buying lottery. The closing was smooth, they got the keys, and they moved into their dream home. 3 weeks later, they got a letter in the mail. It was a notice of servicing transfer. Their loan had been sold to a company we'll call Megacorp Servicing, based thousands of miles away. They shrugged. $40 was $40. What could go wrong? For the first year, nothing. They made their payments on time and everything seemed fine. Then the first problem. Their homeowner's insurance premium went up by $20 a month, a common occurrence. They got the notice from their insurance company and thought nothing of it. But Megacorp's automated system didn't adjust their escrow payment correctly. 6 months later, they received a letter from Megacorp stating their escrow account had a severe shortage, and their monthly mortgage payment was increasing by $300, effective immediately, to cover the shortfall and build a mandatory cushion. $300. They panicked. They called the customer service number. After navigating a 15-minute phone tree and waiting on hold for another 45 minutes, they finally spoke to a representative in a noisy call center who had no idea what they were talking about. He read from a script, couldn't explain the math, and told them the system's calculation was final. He didn't know their town, their insurance, their property taxes. He knew a number on a screen. Mark and Sarah spent the next 3 months sending emails, making calls, and being transferred from one department to another, a full-time job of stress and frustration, all while being forced to pay the inflated amount. A year later, a hailstorm damaged their roof. Their insurance company approved the claim and sent a check. But because the check was over a certain amount, it was made out to both them and their mortgage servicer, Megacorp. This is standard practice. The servicer is supposed to endorse the check and release the funds so repairs can be made. But Megacorp wouldn't release the money. They had a labyrinthine process involving multiple inspections, endless forms, and holding the funds in a separate account, releasing them in small increments only after the work was completed. The roofer needed a deposit to start. Megacorp wouldn't provide it. Mark and Sarah were stuck. A blue tarp sat on their roof for 4 months as they battled a bureaucratic monster that held their own insurance money hostage. The personal relationship, the trust they had with their original lender, was a distant memory. They were just an account number in a system designed for corporate efficiency, not human decency. Their $40 a month savings had cost them thousands in stress, lost time, and utter helplessness. This is the hidden cost of the lowest rate. It often comes from lenders who are mortgage factories designed to originate and sell. They compete on price alone because they have no intention of managing a long-term relationship with you. So how do you avoid this nightmare? You do it by asking one simple question before you ever commit to a lender. You look your loan officer in the eye and you ask, "Do you service your own loans in-house for the life of the loan?" Some will squirm. They'll say, "Well, we service them initially," or "We sell to a very reputable partner." These are red flags. What you're looking for is a specific type of institution, a portfolio lender. A portfolio lender is a bank, often a local or regional bank or a credit union, that keeps the loans it originates. They don't sell them. The loans stay on their own books, in their own portfolio. Why does this matter? Because their entire business model is different. They aren't just trying to make a quick buck originating your loan. They are making a 30-year investment in you. They want you to be a happy long-term customer. They want your checking account, your savings account, your car loan, your kids' college savings accounts. When you have a problem, you can walk into a physical branch and speak to a human being who knows your name. When your escrow needs adjusting, they do it proactively and correctly. When you get that insurance check, the branch manager can often endorse it for you on the spot. They are your financial partner, not just a temporary loan processor. Now, here's the crucial trade-off, the culmination of everything we've discussed. Will a portfolio lender always have the absolute rock-bottom lowest interest rate on the market? Often no. They might be an eighth of a point or even a quarter of a point higher than the online-only mortgage factory. And this is where most people make the fatal mistake. They see that slightly higher rate, they do the math, and they think, why would I pay an extra $60 a month? They choose the lower rate, blind to the 30-year trap they're walking into. They trade a lifetime of service, stability, and peace of mind to save the cost of a few weekly coffees. The world-class homebuyer, the one who is now armed with this knowledge, understands the bigger picture. They understand that the true cost of a mortgage isn't just the principal and interest. It's the total experience. It's the peace of mind knowing that if a natural disaster strikes, or if you lose your job and need to discuss forbearance, you'll be talking to a partner who has a vested interest in your success, not an algorithm designed to minimize corporate losses. You'll be talking to someone who sees your face, not just your account number. So, is the lowest interest rate always the best option? The answer is a resounding no. The best option is the one that provides the most value. And value is a combination of a competitive rate, fair fees, the right loan structure for your goals, and perhaps most importantly, a lender who will stand by you for the entire journey. Don't just shop for a rate, shop for a lender. Ask the tough questions. Ask about their servicing policy. Ask what percentage of their loans they keep in their own portfolio. You are not just borrowing money. You are entering into one of the longest and most significant financial relationships of your life. Choosing your partner in that relationship based on a fraction of a percentage point is like choosing a surgeon based on who offers the biggest discount. It's a gamble you can't afford to lose. The best deal isn't just a number. It's security. It's a partnership. It's the profound, unshakable peace of mind that comes from knowing you made the right choice not just for your wallet today, but for your family and your future for the next 30 years. And that is a return on investment that you'll never find on a calculator.